The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views. I hope all of our listeners out there have weathered the current volatility storm safely and hopefully profitably. My name is Mark Longo from theoptionsinsider.com, and I will be your host for the Volatility Views session this week, but I am not alone, far from it. I am joined, as always, by my lovable companion, good old Don Schlesinger from the Volatility Exchange. Don, how are you doing this fine Friday afternoon?
Those descriptions get better every week. I look forward to them. I'm fine, thanks.
You get more colorful with every passing week, sir.
You got to just think up of a new one each week. It'll get the listeners curious.
That's why they pay me the big bucks, sir. And then we are also joined this week by a special guest. He is Bill Luby. Many of you may know him from his VIX and More blog, as well as all the numerous other ventures you have going on over there. Bill, welcome to the program.
Glad to be here.
All right, and with our team assembled, we will dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is the portion of the show where we discuss what we were watching for the past week in terms of volatility and volatility perspectives. And Bill, since you are the guest, I can give you pride of place if you like. You are obviously watching the VIX and VIX products on a regular basis, and it has been a roller coaster week in terms of VIX performance. You know, we've been watching this for quite a while and commenting for quite a while that we haven't seen the pop, the big move in VIX that we had been expecting for weeks now in terms of everything else that's been going on in the broad market and all the negative news and the downturns we've been seeing. It seems like every time the VIX started to creep up, the premium sellers would dive into the SPX puts again and drive it right back down or keep it steady. It wasn't until this past week where we saw a really good uptick in the old VIX, which of course has since come off a bit. Is that your take as well? You think it was premium sellers who kept the VIX relatively locked in place?
Well, I'm always trying to balance kind of the technical picture and the fundamental picture. And on the technical side, if you think of SPX 1250 or 1260 as a cliff, the closer we got to that cliff, the more people decided that we weren't going to get the buy and the dip activity, and a really better batten down the hatches and prepare for a significant storm. And on the technical side, almost a similar situation. If you want to look at Greece as kind of, the whole European fiasco kind of perched on the edge of a cliff, and the ECB and the Germans debating about what was going to happen, and for a while, and I guess probably up through this morning, it looked like we were on the edge of that precipice as well. So the thought that those things were just kind of blow over and kick the can down the road and business as usual, both of those things I think happened at the same time, and suddenly no one's selling premium anymore. They're looking to protect those portfolios.
Yeah, exactly. The premium sellers tended to vanish in the wake of what we saw recently. But is that what you think was going on as well? Do you agree that the VIX has somewhat underperformed of late until this past week?
I do. I think it's been suspiciously is the wrong word, but it's definitely been lagging. I watch. I have a chart where I pull up the kind of the normalized CPCE, the the equity put-to-call ratio and the VIX, and usually they're in lockstep. And if you look at really since the beginning of June, the equity put-to-call has just taken off, and the VIX has pretty much sat there. And I think the VIX is starting to follow now. But so if you look at the balance between puts and calls, the put side has definitely been heavy weighted. But in terms of the kind of the intensity or the panic effect, the price sensitivity, as what the VIX reflects, that really hasn't been there until the last couple of days.
And before we dive into our Euro vol review, of course, your blog is VIX and More. So are there any other volatility indices, volatility products you've been watching, or volatility in general you've been watching you want to review for our listeners over the past week?
Well, I tend to focus primarily on the U.S. markets, although I do have a proprietary, global volatility indicator that pretty much mirrors the VIX and sometimes shows differences in Asia if Japan is acting up or if, in Europe. But that hasn't been showing anything unusual. I look at V stocks and other things as well. But they pretty much mirror the VIX.
Yeah, pretty much. Those are all kind of different sides of the same coin. And, of course, Mr. Schlesinger, what did we see going on over this past week in the Euro vol?
We actually saw something very interesting on Wednesday. Most of our listeners know that we've spoken about, in terms of the VolContract futures, the realized volatility on FX, that a vast majority of the time we get our partial realized volatility, the actual calculation within the realized volatility period. And then we take a look at the price of the contract itself, and not surprisingly, we see some kind of a risk premium, which acknowledges the general level of volatility that's been going on in terms of the actual formula. But then it's as if there's an inferred or implied volatility that's somewhat higher for the balance of the expiration period, and that makes the contract price more often than not higher than any calculated or partial realized volatility. Well, on Wednesday, we had an interesting inversion. The euro moved a great deal, somewhere in the neighborhood of 1.5% to 2%. And of course, when you annualize such a figure, you get a volatility of anywhere from 24 to 32%, which was way above the 13 that the partial vol was showing. And what happened was that one single day's worth of data instantly jumped that P-vol, or partial realized volatility, from the 13 range to 15.0. So once again, a demonstration of how a single day can make a very big difference in these calculations, despite the fact that they're an aggregate or an average of several days. And with that P-vol at 15, it was interesting to see that the vol contract price was nonetheless only in the high 13s. And that was one of the very few times since the inception of the vol contracts back in February that we actually saw the contract price lower than any partial realized volatility calculation, as if to say this is a one-day spike. It's not something that's going to be sustainable over the next 14 or 15 days. And we'll acknowledge the fact that this day existed, but we're not going to trade the contract that high. And so yesterday, when things stabilized a bit, we instantly had the P-vol come down from the 15 range to 14.18 in a single day, which isn't all that surprising. And you had a kind of a return to a balance between what has been calculated and what's being forecasted for the future, or for the remainder of the realized volatility period. So that was an interesting development, and again, one that we had not seen very often, perhaps not at all, in the previous contracts.
Well, that gets a lot into our discussions we've had previously about the impact of single data points on these contracts and how they will perform and how they will digest and account for aberrant moves like we've seen over the past week or so. So that's interesting to take into account, and I think people who are looking to dive into those products should be aware that it can perform like that.
Interesting, and it's almost mirrors the relationship with VIX futures, which are usually in contango, but will periodically, when we get some activity like this, bump into a backwardation, which is similar to what you saw.
Yeah, because we have this interesting feature with the vol contracts, as you know, Bill, that while they still will exhibit VIX-like properties and a risk premium, and especially before the realized volatility period, will demonstrate some sort of implied premium over what historical or realized may turn out to be. Once we get into that calculation period, it becomes a kind of a hybrid product where you can't ignore the fact that we're accumulating data points and we're actually calculating realized volatility. So that's got to be added into the mix. But then there's still a certain number of days to go, and that's the forecast part. So it becomes very interesting to see what the actual price of the contract is that has to simultaneously reflect the formula part and the historical calculation, but at the same time, the part that's left and the implied part that goes into the actual pricing of the contract.
I think that's a good point there to dive into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to our Volatility Viewpoint segment. This is the portion of the show where Don and I usually bring on a guest, but we're lucky enough to have Bill on for the entire show this episode, so we can dive into a few more interesting topics here as well. And we can dive right into a kind of a continuation of some of the comments we were just discussing in the volatility review section, in that some of the inherent differences we're seeing these days between the implied and realized products. Now, first off, before we even dive into that, Bill, obviously the bulk of your efforts are on the implied side of the spectrum. Have you been watching any of these new realized vol products and some of the things that are coming out these days?
Yeah, I've looked at the realized products, and I think they're very interesting. But from a trading perspective, I tend to focus on the ETFs and the futures and the options related to the VIX and some of the VIX ETPs. So that's the realized portion is kind of a secondary, although I do find some very interesting market signals coming from that. So I use some realized volatility as to help call market direction changes and that sort of thing. So an interesting indicator, but I haven't ventured into the trading portion of that yet.
Bill, we seem to hear from a lot of people as we do our research and we try to gather intelligence that the supporting derivative products such as options and related ETFs could prove to be extremely beneficial for shoring up the volume going down the road, not just for the Euro FX vol contracts, but for the entire concept in general. I wonder if it would be your opinion as well, as we start to bring out other such realized volatility futures products, whether from a trader's point of view, you feel that the addition eventually of options and ETFs, such as was done with the VIX, would probably be a boon to volume.
I think it would be a huge boon to volume, just because there's kind of a network effect, if you will. You trade one part of the product suite, and it seems like all the other products in that suite or related products get affected. I also think that there's some very interesting pairs trading opportunities that I certainly am going to put a lot more research into. That I think, and I haven't studied those really on the FX platform, but I think as you expand the product line, that they'll be more attractive to me as an individual trader and probably institutions as well.
Sounds good. Thanks.
Now, Bill, when you look at realized vol products, is that just through your own calculations of historical / realized vol, or do you look at OTC vol trades as well, the variance in vol swaps, or what are you looking at?
Yeah, most of my stuff is in this fancy Excel spreadsheet, I must confess. No, so most of mine are internal calculations that I do based on the major indices and that sort of thing. I do periodically look at some of the the CBO products and other third-party products. But I have a tendency to want to do whatever I can in-house as long as it doesn't overwhelm my one-person research department.
So you're slinging a high-end Excel spreadsheet. Is that at least Excel 2010?
I've just upgraded, so now I can actually pretend that it's high tech.
Okay, so you're no longer in the dark ages of Microsoft Office 2000 or anything crazy like that.
No. Don't ask me what version of Word I use, because I'll get in trouble. But the farther back seems the one that's the most friendly to me.
Don, I think we know you're still using a Commodore 64 over there in your offices. Bill,
all right, you caught me again.
Now, Bill, obviously you do work a lot on the VIX end of the spectrum, and it's interesting to me to still see, even in this day and age, and even with the activity we saw over the past week being a good counterpoint to that, we're still seeing VIX being pushed and marketed and discussed in the broad media as a hedging tool and as a way to hedge your broad portfolio risk. Now, when people come to your VIX and More blog and ask you questions, I'm sure quite a few people do, I'm sure you get this question a lot, should I use VIX as a hedge? Is VIX a good hedge? What do you tell people? Did you recommend they go out there and pick up VIX calls to hedge their portfolio as opposed to S&P downside puts, or what are you telling people these days?
It's difficult because if you're new to the space of VIX products, then your ability to jump right into VIX options is close to nil. So there's generally a longer education process with the VIX products than there are with most other products. So you really need to learn the underlying futures, then you need to learn how the options work, and you need to be familiar with kind of some of the idiosyncrasies, everything from the different timing cycle, et cetera, before you can make an informed decision on how to use the product. And then they have the VIX doesn't move in a linear fashion. On some days it does have that convexity when the market really goes down hard, the VIX will spike up a lot. Kind of as an accelerated move. If the market goes up a lot, it'll have generally a more muted move. So it's a difficult product to trade. It's a difficult product to understand and get your arms around. That being said, if you have the background and knowledge or are willing to take the time and educate yourself, I think it is has the potential to be, anyways, a relatively inexpensive hedge, as well as you kind of pointed to earlier, a sometimes inexact hedge when it doesn't necessarily track like it has been for the last month or so.
I have a question, and it's very possible that you've studied this on the blog. I tried diligently in the last few days to come up to speed, but you have such a wealth of material that despite my valiant efforts, I obviously couldn't read everything and get completely caught up. But pursuing this hedging concept a little bit further, we all know that in the equity space, we have this very strong negative correlation between volatility, whether it's implied or realized, and the actual price movement of the underlying, let's say an S&P 500 index. So we know that when the market goes down, VIX goes up, realized volatility tends to go up as well. And when the market goes up, usually in a more orderly fashion, both asset volatility and VIX tends to drop the vast majority of the time. I was wondering if you had done any studies, because I've tried to eyeball it day after day, watching days when the market drops rather sharply, looking at the corresponding VIX increase and taking the percentage movements of both to try to see a kind of a ratio, and then doing the same thing to the upside. And, what I kind of eyeballed and found was that on days when there's upside movement, the VIX percentage move might be 4 to 5 times what the asset move is. But to the downside, on a very broad and generalized basis, it's almost twice as much. And you'll see VIX increase by 8 to 10% when the market makes a 1% move down, and by even more if you get a 2%. It's not linear, as you mentioned. I'm wondering if you've studied that or you've seen any studies relative to this, because you realize that the implication is for hedging, if somebody were going to use the futures, it'd be very difficult to be right in both directions as to the quantity. simply because the VIX doesn't move in the same magnitude given the exact same absolute value move when the underlying goes up or down.
No, that's a very good point. Yes, I have studied a great deal, have a lot of have a lot of data on the subject, and I'm actually just finishing up an article for Expiring Monthly that'll go out in another week or so on this very same subject. So, as a rule of thumb, if you consider that for every percentage move in the SPX, expect the VIX to go minus 4x. And that's a pretty good 4 to 4.2 is probably a good, but that just gets at kind of the median, and it's the values of the extremes that are most valuable to the hedgers. And it's always fun to do this on radio, is to draw this imaginary curve in your head, but it does the values start to accelerate and go up dramatically, steeper slope as you get to a sharper downward move in the SPX. And again, when you get to the bigger up move in the SPX, there is a flattening out. So, and you that's just the VIX though. But the products are generally based on the futures, and then they have the futures that are pricing in some mean reversion, and so the futures don't really move like the VIX. So even understanding the VIX doesn't necessarily get you to where the futures are and where the options are going to be based on the futures. So that's part of the complexity that I was referring to earlier. But yes, if you can slay the VIX dragon, then you're halfway home, I think. And it does create a nice little kind of a C curve, if you will, with sharply up on the left side where that negative correlation is, and more flattening down on the right side. Again, great radio to draw these curves in the air.
Well, it's a very interesting phenomenon, and for our listeners, if this sounds a little confusing, I just kind of invite you, as you're watching your CNN or CNBC every day, where they disseminate the actual VIX, so the index, and then the market levels themselves. Just take a look when they show you the S&P. It's up or down by X% every day. And then take a look at the VIX movement and calculate that percentage change yourself, and you'll see just what Bill and I were alluding to, how when you have upside moves, you have maybe a little bit more percent, or 4 times the movement, but as soon as you start going down, the same percentage downward movement accelerates, and you have larger. The complication comes, as Bill mentioned, that the futures simply aren't the same as the cash. So you can do all of that, and then when you've got the futures, you've got a real tiger by the tail, and it dances to a different metric.
It's interesting you brought up the futures, because we had Tom Sosnoff, the founder of Thinkorswim, on the show last week, and we got into a little bit of a discussion about VIX and VIX futures. And his comment was that for the vast majority of the retail audience, the VIX futures are essentially an irrelevant product. I found that to be interesting, and of course it dovetails in very well with what we see on Options Insider, and I'm sure you see on VIX and More as well. Is to this day, even without all the education that's been done on this product, still the number one question we receive on VIX options is, why don't they key off the cash? And I could make a living just answering that question if I could get paid every time and make a good living on a daily basis of the volume of times that question comes in. So do you agree with that comment that the VIX futures are essentially irrelevant for a large portion of the audience?
No, I actually disagree strongly. I think that many investors, retail investors in particular, think they're irrelevant, but then they go out and they buy VXX or they buy a VIX call, and they can't figure out why it's not moving the way they thought it was. And then there's a little educational process, hopefully, and then they realize, oh my goodness, I thought I could kind of ignore these futures things. I thought I could kind of jump into the options or the ETPs because they were simpler. That's not the case. You have to, no matter what you trade in the VIX product universe, you have to understand the VIX futures.
So you think they come in with the futures being irrelevant, and then they get bit a few times, and then they are forced to learn about the futures and how they move the cash?
Mm-hmm. If you're a quarterback, I'm not going to worry about those blitzers. You get sacked a couple of times, and now suddenly you need to think about the blitz a little.
Well, it's pretty funny, Bill, and you couldn't be more right. I mean, people who are used to trading options, and I think that Tom was advocating, options are where the action is, need to understand that this is a rather strange creature. So they go in and they say, I want to trade volatility, and I'm an options trader. So, let me hit those options. They have to understand that options owe their existence to some underlying, but the underlying is not the cash, it's the futures. So that's what they're derived from. And if you're going to go in, you're going to claim that you're going to trade the options and you don't understand what they're trading off of and what their value is based off of, you're going to be in a lot of trouble very quickly.
I couldn't agree more, and I can understand where Tom was coming from, but I see a lot of people getting blindsided by the VIX futures piece, and it's people, frankly, who have never had a futures account or thinking kind of they can take a shortcut, if you will, and not having to bother to learn about the futures process because they don't have to learn about S&P futures to trade the spiders or something like that.
Right.
Would you say that's still the number one question that comes into VIX and More is why don't they key off the cash, the options?
Yeah, in one way or another, I think it has to do with that. Because since so many things get back to that, that becomes the root cause of a bunch of questions that land in my inbox.
That's interesting because that all stems from the way that this product was designed or redesigned back in 03, 04 as the SIBO sought to make into more of a tradable product and to mirror it off the way they designed the SPX in a lot of ways. And of course that made sense at the time because everyone and their mother thought VIX would be a purely institutional product. No one thought that retail would be diving into this, let alone in the droves and droves that we're seeing these days. And so now that we're coming up on 7+ years or so since the redesign, this product could be getting due for yet another redesign, perhaps to make it even more relevant to the way it's being used today. If they were to sit down and say, hey, we're going to redesign VIX again, what changes would you like to see made to the product going forward?
Oh, my. I hate to say it, but I won't call it a flawed product, but a product with so many idiosyncrasis.
Go ahead. We call it a flawed product all the time.
Creates so many trading opportunities that, I'd hate to see some of those trading opportunities disappear. On the one hand, I'm really not in the business of educating, but I've kind of ended up in that educational corner of educating a bunch of people about the product. If there was something to come out that was, perfectly transparent and didn't have all these strange ETPs with contango and all these strange things going on, then I would make my trading life more complicated. But I'm not going to make a specific recommendation to how they might redo the product, although I can say that a realized volatility from a hedging perspective certainly has a great deal to recommend it because you're more concerned with what's actually going to happen to your portfolio than what some sort of derived function about what might happen to your portfolio does. So I think it's an excellent complementary product, at the very least, when you look at alternatives to the VIX.
And Bill, it's really interesting that you say that about the trading opportunities because we've been talking about this internally at the Volatility Exchange really for a couple of years now. And when we go out and we make presentations and people bring up VIX and we talk about our product, we continually don't want to be VIX bashers because we understand very well that there are some very intelligent people making a living trading this product. And, who are we to tell them that we've built a better mousetrap and that we want to replace that product with ours? And it's really not what we want to do at all. We really do want to have this complementary relationship, if you will, Coke and Pepsi or whatever, and say that there's surely room for both and that they will create hedging opportunities, spreading opportunities, intermarket type of trades. So this is what we're really hoping for, to really piggyback on the obvious success of VIX and tip our hats and say thanks very much for being there and blazing the way to get people talking about volatility every day. And now maybe you'll consider taking a look at this. It's an alternative product. It's got some interesting features. And then we can all live and play nicely together.
It makes a lot of sense. And when you think of that, presumably sometime in 2011, I hope we'll get RVX futures out based on the Russell 2000. And presumably a suite of products that grow up around that. And you've already got 16 VIX ETPs or volatility ETPs. They might not all specifically have VIX in them out there. there's a growing product universe, some of which are very actively traded, and some of which, as you point out, when you start combining pairs trades and have multiple legs or multiple products in your position portfolio, you can get some really interesting ways to play the market, play direction, play volatility, play no direction, play whatever. Really, no, all I can say is I certainly make a living trading just these products, even though I enjoy looking at the full spectrum of the options universe. The volatility product space is a big enough sandbox for a lot of people to play in.
Well, Bill, it's interesting. At the very least, I'd imagine you'd have to fall into the looking for a revamped settlement process, perhaps, for VIX. There is a chorus we're hearing these days, is that the settlement is just all over the board. It's a lot of times settling at prices we didn't see intraday. There's people who can go out there and attempt to game it by picking up these way out of the money SPX puts and try to game it that way. So I'd imagine you at least would be interested in seeing a revamped settlement.
Yeah, the settlement process is certainly not without its shortcomings. You can easily get around that by just not having any exposure on the settlement day, or make sure you have the weeklies or the next month or whatever in terms of your expiration. But yeah, it would be nice if there were days where the VIX settlement did not fall outside of the VIX trading range for that day, and there are some other ways to do
heresy,
that.
Sir. That's going to do it for our Volatility Viewpoint segment, and now we're going to roll into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is, of course, where we prognosticate wildly about the week to come. And we are recording this on a Friday afternoon, and right now the S&P is up about nearly 5 handles at 1272. The Dow is up 46 to 12,008. The NASDAQ, ever the laggard, down 3 points to 2620, and the VIX cash down 0.66 to 2207. And yeah, you're right. It seems, Bill, the market seems definitely to be pricing in a lot of what we had expected it to price in earlier. It took a little while for the index to catch up. I think now it's finally starting to price in what we're seeing. Of course, we are trading at 22 right now. If you had to pick up the 1725 strangle in VIX right now, which end of that would you be leaning more heavily towards?
It actually, as always, it depends on the price, but I think it's probably overpriced right now, so I probably would be shorting that. But on the other hand, I think we're more likely to end up on the lower end of that side. So I might actually, there's a temptation to go long or take a directional bet on volatility moving down, which is kind of where I'm leaning right now.
You know what I always say, Mark? Tell me whether the market's going to go up or down, and I'll give you the answer right away.
Oh, Don, you and your 50% guarantees.
Well, 99% of the time I give an answer based on technical analysis, but I've been saying for the last month or longer that volatility is all gonna go based on how the VIX situation plays out, and it's kind of hard to predict how. I guess there's some progress made today in terms of at least the ECB and the Germans being on the same page. But it's hard to predict what's going to happen on the weekend, especially when you have some big meetings with the finance ministers and then the leaders coming up next week. Clearly, the market has assumed some bad news in the current pricing, but it's hard to say. It's going to be a binary market. I think we're not going to be at where we're at, VIX 22. We're not going to be there next week. We're more likely to be at 17 or 27 than we are at 22.
Don, what are you seeing for the coming week in Euro Vol? Of course, we talked a lot on previous shows about the possibility for volatility arbitrage in those contracts. Those contracts have since settled, and you've seen some very interesting movements in the new contracts that you just listed. So do you expect that variety of movement to continue going forward?
Well, my thoughts, and again, I'm not an expert on the euro or its movement. These are towards the very high range of values that we've seen, which doesn't mean that can't persist, but taking a look at some of Robert Engel's work at the Volatility Institute and his predictions for both the settlement price of the July 1-month contract as well as September 3-month contract. He's got both of those in the 12 handle, whereas the contracts are trading at 14.10 settlement last night and 13.61 for the 3-month. So if I did have a lean, it would probably be also to see these come off a little bit.
All right, and that is going to do it for our crystal ball segment. And you know what, Don, I think you made a good point before. Why don't we do a quick mailbag, because this question is about Excel, and I think Bill might be able to chime in on it as well, because he is, as he said, an Excel guru.
Listener mail. Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and welcome to the mailbag segment. This is, of course, or the listener mail segment, I should say, where we open up the old Volatility Views mailbag and see what our listeners have in store for us. And this week, it's a question from the Options Insider forums from a user who goes by the handle Rhombus. I like that handle. And he says, "Hey guys, great show. I was going through some historical stock data trying to calculate the historical volatility when I ran into problems on calculating the volatility. When using a basic standard deviation calculation, such as in Excel or any other calculator, each daily return is measured against the average daily return across the whole data set, whereas the market expects the average daily return across the data set to be 0%. While I can find ways around so that Excel gives me an accurate calculation of the historical volatility, do you guys find in practice it is better to use the average daily return for the given period or the market expectation of 0% daily return? I would think in trending markets you would want a bit of a bias to the direction of the trend, so you would use some sort of average daily return, or maybe you could use this as a bit of a discrepancy to gain an edge if one were so inclined. Thanks, Rhombus." And Don, since you didn't answer this, I think you can dive in first. But I know, Bill, given that you have said you are the Excel guru and you have updated all of your Excel, you might want to dive into this as well.
Well, the question is a rather fundamental and important one. And again, Bill has written on the topic, and I look forward to his additional comments and instruction about how to build this in Excel. The problem with the traditional standard deviation calculation is that it's generally used for the types of things that we see in statistics textbooks, like taking all the heights or weights of all the fifth graders in the country and using a small segment of all of them, what we call a sample population, and trying to estimate and make intelligent comments about dispersion around the mean from just a small sample of the entire universe or population. And so subtracting the mean from the calculation works well when you're trying to do that kind of thing, or when you're trying to take an exit poll and you only interview, one voter out of 1,000 or something like that. But it works a whole lot worse and not as well when your entire sample is in fact what you're trying to calculate. If we say we're going to calculate volatility for this month, we're not trying to use that to estimate what volatility might have been, from 100 years or whatever. We want to know what the standard deviation was for that month. And when you subtract the mean, you are in fact adding this type of trend annihilation, if you will, that leads to some very strange results. So suppose a market went up 1% every day for a month, say 20 trading days. Most people would say that's a pretty volatile market. We were up over 20% in a single month. My God, the market's really moving. The problem is if you use the traditional removal of the mean, the volatility turns out to be 0 because you move the same 1% every day, so that is the mean. And when you subtract the mean from the daily returns and their 1% every day, you actually come out with the comment that, gee, that market wasn't volatile at all. The volatility was 0. And that's rather disturbing to a lot of people. So when they do variance swaps and when they do volatility swaps, they assume a mean of 0. And so what you see is what you get. The movement is the movement. They don't subtract the mean from it. And we've adopted that policy at the Volatility Exchange, and all the calculations for vol contracts are done assuming a mean of 0. Bill wrote in his piece that it's a lot simpler and a lot less complicated to do that as well. I also think that it leads to more realistic results, especially when you have a very uniform movement like the one that I described over an extended period of time. So I'd be delighted to hear Bill's further views on the topic.
Well, that's funny because I was going to say exactly what you said. I was even going to use the exact same example of the 1% a day for, whatever your period is, 20 days, 30 days. And that's, as someone who is trading based on trends and wants a volatility and trending calculations to be different or to give me new information, I want to have both of those pieces of information. I don't want to have some sort of trend statistic screwing up my volatility statistics, so I'm not getting what I would consider to be a pure volatility that would come from a mean of 0. So I agree with everything you said emphatically. And I think that a mean of 0 is a much more accurate and valuable to the trader. And the fact that it's simplistic and makes for easier Excel calculations is a plus. I don't think that that tail should wag the dog. I think you should try and get at something that provides you more information and it's more value. So yeah, take the square root, and then you have to decide. Take the standard deviation of your series. Then you have to decide whether you multiply it by a square root of 252, 256, or 365, or however you're going to decide how long a year is. And that's a separate discussion entirely. And that's it. There's your volatility.
Well, we put that to rest, Mark. Anybody, if you're subtracting the mean, stop doing it.
Bill, this is, I think, more of a religious question, but I'm kind of curious where you fall on that, since you did mention your use of the year. What do you go by? Do you go by trading days? Do you go by total annual days of the year? What do you use in your calculations?
I do 252. That's generally the number of trading days. 256 is the great shorthand because of the square root of 16. But when you look at your typical volatility from a Friday close to a Monday open, over the long run, it really isn't that much, and certainly not, as far as I'm concerned, warrants crediting it for 2 additional calendar days in which nothing is actually traded. So that Monday morning gap doesn't warrant, to me, using 365 in there.
I tend to agree. I'm much more of a trading day man myself, especially when I'm looking at volatility. Sometimes when I'm looking at decay and I want to analyze decay across a contract, I will go the full 365 because decay never takes a day off. But other than that, when I'm looking at modeling volatility and analyzing trends, that sort of thing, I definitely tend to look at the opportunity days when I can actually trade it, which is, of course, the trading days. Don, do you fall on that side of the spectrum as well?
I certainly agree with that. I absolutely agree with it. And of course, my motto about they die a little every day, when you mentioned the decay, you're absolutely right. They never take a day off. You've got to do it for calendar days because you're owning an option and the market is closed, and you come back on Monday and by gosh, it's just not worth the same thing that it was on Friday afternoon. So although they do start taking some of that decay out in anticipation of the weekend, it clearly is the case that not all of it comes out, and you come back and the calendar counts Saturday and Sunday just as well as, Monday through Friday. So, but volatility is different. It's very hard to be volatile when the market's closed and not trading. So I think we're all on the same page there.
Just as an aside, when you were talking about the curve of the VIX and the VIX being 4x the changes in the SPX, or I guess I was as well, that of course that creates distortions on Mondays when you see it looks like the VIX is spiking and people are panicking. If it's been a 2 or 3 day 3 days since the market has traded, then that's inflated by some of the decay that was kind of pre-accelerated on Monday and on Friday and appears again on Monday. So that creates a distortion in that number.
Oh, definitely. I mean, this is not exactly a listener question topic, but it's interesting nonetheless since you brought it up. How much does it drive you crazy? I know it drives me crazy to see, the broad media just going crazy about VIX movements on a Friday or a Monday and not at all taking into context the actual weekend coming out and coming back in and how the impact that will have on the VIX cash number. In fact, if there's one major complaint I have with all the usage of the VIX cash and the overusage of it, I would say, it is that there is no context ever really given for it. They don't say, oh, the S&P is down 30 handles from the last point where we were trading at this VIX cash level. That's never discussed. Where we should be on the skew curve is never discussed. The time decay coming in and coming out is never discussed. And so it must drive you crazy as well to see this VIX cash number bandied about without any real context given for it.
On the other hand, all misinformation creates trading opportunities. So not that I want to encourage misinformation, but that means that through the perceptive trader, there's just more opportunity out there.
That's a very Darwinian viewpoint. I like that, sir. Feel free to make your errors. I will profit from it. That's what Bill Luby is saying. That's going to do it for this listener questions segment and this episode of Volatility Views. I want to thank our guest, Bill Luby, for joining us on the program today. And Bill, obviously you have VIX and More. You also have expiring monthly. In fact, we didn't get a chance to discuss expiring monthly that much. So why don't you give our listeners a little bit of an update of what you do over at expiring monthly and what it is, and maybe a plug for the upcoming issue.
Sure. It's a monthly electronic publication based on options, and I work with 3 other members in the option space to make it happen. Jared Woodard of Condor Options, Mark Sebastian of this program and other places as well.
We don't talk about that Sebastian guy. I don't know.
Mark Wolfinger, the 4 of us, and some guest writers author content every month, and that's the reference where I made to the upcoming VIX article that I'm putting about the curved VIX, and I don't have it in front of me, so I don't know what's coming this month. But there's about 30 to 40 pages every month of content related to options and volatility, and it's something I can highly recommend for the beginning, intermediate, and even advanced trader.
And in addition to expiring monthly, and of course the blog, VIX and More, anything else you want to let our listeners know about?
Know that I am pro-education, and I'm not a trading Darwinist, but
it's too late, sir. You have been labeled such.
I do want people to know there are opportunities out there, and I think if you have questions, the VIX and More blog is a good place to start. Shoot me an email, and I'll be glad to do whatever I can to educate the VIX trader.
Yeah, I highly recommend everyone surf over to the blog and check out your top 10 questions, things you should know about the VIX. That's a great post for everyone who's thinking about diving into those waters. Should at least start there and familiarize yourself with what's going on those VIX products. And of course, we'll be happy to see our Options Insider link added to all your favorite blog posts as soon as you possibly can there, sir. I noticed actually the blog is looks like it's about once a week. Is that how often you're updating the blog?
Well, it really used to be a daily thing, but I have cut back a little, and I've actually been out of the market a little bit lately, but I expect it will pick back up to at least 3 or 4 times a week again. Because
I was over there looking at it earlier, and it looks like Apple was your big post, most recent one. So you're taking a lot of time to parse the individual equity volatility as well?
Not so much as I was one of the. There's no way to make this long story short, but I have never been an Apple fanatic, but recently took up the iPad and have found some interesting anomalies going on with the stock, and thought I should throw up some comments because people are always interested in Apple, whether they follow the rest of the market or not.
That's true. It's kind of like VIX. Anytime you put VIX in the headline, people will read the article. Apple, same thing. You put AAPL anywhere in the headline of the article, people will open it and read it. They're obsessed with that name.
And that obsession also creates some interesting trading opportunities because people don't think rationally about that stock. Same thing as the VIX, like they do some other stocks.
That's true, and we're seeing it's off again today, off nearly 5 handles right now, to hovering around 320 again. So Apple having seen some interesting vacillations of late, and definitely a good stock to watch from a volatility perspective. And of course, Mr. Schlesinger, what is new over at volex.us that you want to let our listeners know about?
Just a quick preliminary announcement. There'll be more information about this as the weeks go by, and we mentioned Mark Sebastian a little while ago and talking about all of us being pro-education. The Volatility Exchange, in conjunction with a joint sponsorship with CME Group and the Price Futures Group, is going to be offering a webinar on the Euro FX and the current vol contracts, and that webinar is going to be given by our very own Mark Sebastian, the COO of Option Pit.
You just can't escape that guy these days. He's everywhere.
He's a wonderful teacher, and it will be held on the 12th of July, and the time will be, I believe, 12 noon to 1 o'clock Central time, and we'll have a link to that, as will the other co-sponsors on the various sites. Ours will probably be up within the week, so there'll be more information forthcoming, but I did want to give our listeners a heads up that that's in the works, and we'd love to have them join in. It's free, and I think that they'll learn quite a lot.
And listeners, of course, if you'd like to learn more about any of the volatility topics that we discussed today, or leave some feedback for Don or myself, or maybe if you're lucky, even some of our guests will get to chime in on your questions, then by all means, surf on over to theoptionsinsider.com. If you'd like to leave some feedback for us, then surf on over to the forum and scroll on down to the Volatility Views listener questions forum, where you can leave your questions, and Don will answer them right away, as he is wont to do. And then if they're very interesting, we'll bring them up again on the show. And of course, the more daring of you can leave us voicemails at 312-544-9356. You can also follow us on Twitter, twitter.com/options or twitter.com/volex_info. And Bill, I don't want to leave you out of the mix. Do you have a Twitter handle you want to plug as well?
It's VIX and More.
Is it VIX and A-N-D more?
VIX A&D, yes. Okay. No ampersands in my life.
I didn't know if it was just N or anything like that. Okay, perfect. VIX and more. You can follow Bill. And I want to thank all of you out there for downloading and streaming and subscribing to this show and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.